I'm going to try to be a little bit provocative, keep you awake and keep you entertained before the coffee break. It was unplanned, but that last presentation by John was a great lead into what I'm going to talk about, which is hacking financial regulation. We're going to start in 1971. Who was born before 1971 here? Who was born after 1971? Okay, so 2/3, 1/3. Something important happened in 1971. A company called Intel launched a microprocessor on a chip called the 4004 and started what we call the information economy. This is kind of a big deal. I'm not going to spend a long time on this. I have 15 minutes. But this is a new industrial, economic, social paradigm that's replacing 250 years of the industrial economy. And that's very, very important because all of our society, our corporations, our economies, our institutions, our rules have been building over 200 years and are optimized for a certain set of conditions. And those conditions are changing. And everything that we try to do today in terms of adapting to that change in the context of that industrial framework is leading to diminishing returns and growing obsolescence. And it's our firm belief that the financial crisis, for instance, the Occupy movement, all of these seismic tremors that we're feeling in our society across the globe right now are symptoms of this underlying transition. And give you an idea, the last time we saw a transition of this magnitude, and it was much, much smaller because the world was much smaller, was 250, 300 years ago as we went from a feudal agrarian society to an industrial society. This is a big deal. If you look at history over that time, it was pretty traumatic. And as I said, today we've got 9 billion people or 7 billion people. The world's connected, and all this is happening at speed. So why is this important, and how is this relevant to regulation? Well, in this context, we've got, this is financial. This is how we draw a map of the financial industry in the industrial economy, and we're moving to a slightly different type of industry in an information economy. The products and services, or the fundamental products and services, not the specific surface level ones, are the same. People need to save for retirement. They need to manage payments or transactions. But the way that it's organized is going to be different, we believe. So, here's a quick little map of the incumbent space, some of the leading financial services firms from across the spectrum today. And they've got a set of regulations by country, but that have grown up around their operating paradigm that's adapted to the way they work. They are adapted to those regulatory regimes. So let's pause for one moment and talk about what regulation is for, and particularly in financial services. If you look on Wikipedia, if you do a bit of research, there's various different types of regulation and purposes for regulation, but one of the most important ones in the context of financial services is to avoid market failures, to constrain oligopolies or monopolies, to assure adequate information, so the whole question about transparency, consumer protection, and to mitigate systemic risk. That's particularly important in finance. You notice that I don't think, or would anyone disagree that the purpose of good financial regulation is not to protect incumbent business models and their rents? Should that be a stated purpose of regulation? And as John was saying, unfortunately, with regulatory capture, that's often the case. So here we have this new burgeoning universe, and there's hundreds more, and it's growing every day, of information age financial services companies. Some of them very young, some of them growing quite quickly. What if we set up a regulatory regime that was adapted to those business models, to those companies, instead of trying to imply the existing regulatory framework on a new set of models? And bear with me, this is important. And this is one of the things that if you read one book this year, if you haven't read it already, read Technological Revolutions in Financial Capital by Carlota Perez. I'll give you the ending. I'll give it away, but it's still worth reading. One of the fundamental drivers of our economies is technology and economics businesses tend to move faster than our culture and our institutions. And when you get periods of sharp acceleration in that, which we've had over the last 20 years, you get these disconnects and these seismic shifts in society. So my premise here is, why don't we recognize that, and instead of waiting for 10 or 15 years for our institutions to catch up with the new way that we run our world, why don't we set up institutions that are purpose-built for this new world? So what would that look like? What would be the key tenets of an information age financial regulatory framework? First and foremost, foster competition. By definition, this is a regulatory framework for startups, growth companies, for what's new. So creating a framework that accelerates that endorses that supports that. One that takes a probabilistic approach to risk. What do I mean by that? We need to get away, and particularly in this context, from a risk framework. And I think this is one of the great failings of the late 20th century, is this idea that we could solve all risk and make risk disappear. Probabilistic approach to risk means that some things will fail. Sometimes people will lose money. Sometimes bad things will happen. But the costs of trying to completely mitigate that, which I think is a Sisyphean task anyways, are enormous and create huge externalities on the market. So I call it the first law of financial dynamics. Risk is conserved. And I used to be a trader, a banker. I tell you, you can move risk around. It looks like it's disappeared, but it hasn't. And it just jumps up and bites you in the ass when you discover it. So you can transform risk, but you can't create or destroy it. I think a regulatory framework, particularly in the context of something that's very dynamic, new, changing, that recognizes that and accepts tolerable risks and tolerable losses, is something super important. Leverage behavioral psychology. Here it's all about, there's good and there's bad. Historically in financial services, some of the winning business models have leveraged behavioral psychology, but in a very, very cynical, evil way, preying on our innate heuristics and biases to create profit-making opportunities. I may be naive, but I think you can build really sustainable, profitable, interesting businesses that flip that on their heads, and they help their users, whether they're retail, consumers, or businesses, to profit from these biases. Focus on people. This is probably the single most important thing in my proposition here, is a regulatory environment that first and foremost is focused on the people that run these businesses. You find trustworthy people. I'm not saying it's easy, and so it was fantastic again that Rachel's presentation was a perfect intro to this. I'm not suggesting it's easy. I don't have all the answers, but if you create a regulatory regime that focuses on people, authenticity and competence and trust, I think you're going to solve a lot of problems before they emerge. So what am I talking about really? Well, it's a venture capital type framework for a regulator. So let's start a regulator. Let's do a startup regulator, or an incubator of regulators that is focused on this space. Many small experiments, probably open crowdsourced. Let's get the crowd writing the codes. Let's lead into winners, regimes, rules, frameworks that work. Let's do more of that. Ones that don't, let's stop using them. And since we're starting with a green field, with a blank slate, with a clean sheet of paper, let's not go back right away into this box-ticking mentality of, if it's not prescribed, it's permitted, it's evil. And I've seen good people in banks do bad things because buried in a forest of regulation, they start looking for things that are allowed to do without asking whether it's right or proper or interesting that they do those. And again, there's always bad people, but I'm talking about good people doing bad things because of a framework that is past its sell-by date, perhaps. But in particular, when we're talking about these kind of companies, they're small, they're growing fast, they're not systemically important yet. Let's take some risk, let's experiment, and let's build the new regulatory frameworks that will underpin this information age for the next 50 years, rather than waiting for it to happen. So I'm just going to finish very quickly. What would, for instance, a banking regulation framework look like? Well, you could limit the balance sheet size, you could limit the leverage ratio, you could require simplicity, transparency. So what I'm saying here, you could allow social KYC, create sandboxes of experiments. I'm not saying, you know, that HSBC or Lloyd's or NatWest should be regulated in this way tomorrow. Maybe in 15 years, once we've proven this. But a small bank with a £100 million balance sheet, with fairly simple balance sheet, you're not taking a lot of risk. And if the right people are at the top of it, and you've vetted them and you've made them responsible, it's even less of a problem. The other point is, in the startup space, in financial services, if it's a business that requires regulatory or risk capital, let's separate those two things. Maybe even mandate that. What companies that we work with, that we help to build, we suggest that they do that. It makes a lot of sense economically. But from a regulatory perspective, it makes sense as well. Keep the operational capital separate from the financial risk capital. This has a lot of advantages from an economic point of view, but from a risk or systemic risk point of view and consumer protection point of view, it does as well. So no debt in the operational side, and balance sheet management on the financial side. So we're going from this old world into this new world. These two worlds will coexist for at least the next decade, maybe 20 years. Let's speed the transition from an industrial age rule book to an information age rule book by creating a sandbox, by creating a new venture approach to financial regulation for new business models, and hack financial regulation. Thank you.
So sure, thank you. You're putting your investors' money where your mouth is as well. Just give us an idea of where you've been seeing specific opportunities and where you have been investing.
So yeah, well, it's very interesting because we started working on Anthemis 5-6 years ago. I like the phrase, Wayne Gretzky's phrase, skating to where the puck will be. And it looks like the puck, we've arrived all at once with the puck. There's lots going on. There's a Cambrian explosion. So now our problem is there's too many interesting things happening and it's filtering signal from noise. But some of the most interesting things that we're looking at high-level themes, and then you can apply these in different markets, are data-driven, sensor-driven, real-time behavior change in a transactional environment. So I'll give you an example. One example is Movin, which is just launching their product now in the US, which is really giving you real-time information on transactions, on what you're spending. Another one might seem completely different, but the theme is the same, as a company called Automatic, who actually just shipped their first products this week, which some people are calling the Square of driving or the iPod of driving, but it's about taking sensor data combined with, I don't have my smartphone with me, but combined with this wonderful computer in your pocket and the ability to process massive amounts of data in real time to allow you and me to make better decisions. And the key here is real. We think one of the big keys is real time. It's an order of magnitude, 2 orders of magnitude more useful than something that you get at the end of the day, or certainly the end of the week or the end of the month.